Welcome to the monthly MOTR Checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. This month, we're going to reflect on recent market activity, particularly the end of this month. This past Friday, we had quite a headbanger of a day for the leadership, but we think right now we're okay. But Friday's action, as we'll discuss, might have potential rumblings of worse things to come as the year progresses. So after posting a very strong start to the year, new leadership, new era leadership got pounded on the last day of the month in January here. And being long this leadership for several months now, we are painfully aware of this recurring pattern of month-end weakness. But so far, thankfully, it has proven to be just a speed bump in the new era ascension in leadership. But Friday's reversal was certainly more violent than any other that we've seen so far. So we were very, very mindful of the idea that with this increasing volatility, it's just more evidence that our view that we're in a bubble is continuing to play out. Yes, Friday was a very rough day for the new era leadership, but the month was spectacular, which I'll show you. So even though it was a tough day, the leadership was still very strong on the month. Precious metals in particular may have seen a warning shot, may have sent a warning shot across the bow that might be quite relevant as the year progresses as well. So overall, our view remains the same. We are in a bubble. It's likely not over yet, although we do still think that 2026 is likely the year that it does end. And just from a point on a calendar perspective, in terms of how things tend to end in a crescendo with a meaningful event surrounding that terminal activity, maybe it coincides with the midterm elections and the volatility that's likely to surround that period. So just to begin, the risk gauge, which we've been writing about all month, unfortunately, failed to hold on to its risk on reading into the end of the month. So we were hoping that we'd get a close above here, which would be our first close of all three of these in risk on since early to mid 2020, which was a risk on reading that lasted all the way through to the mid to latter part of 2021. And that is the last time this risk gauge has actually been risk on in all three timeframes. And so this is the equally weighted version. This is the cap weighted version, which up until recently has been clearly significantly better than the equally weighted. But nonetheless, you can see here that the short term has fallen out, but outside of that, we have still risk on here. So this is good. It's clearly not robustly bullish, which is a theme we've been harping on. You can just by way of example, you can see that only 63% of the MOTR universe is above its 200-day moving average, and not only necessarily, because 74% is not terrible, but it's 74% with a rising 200-day. So again, if this was really strong and robust, these two numbers would be much better than this, and this would be well up into this space. So again, it's not bearish by any stretch. It's just that it's not your typical bull market. But more importantly, with recent price action, what we're seeing now is that this is a version of the risk gauge that I don't think I've ever shared this actually, but this is the equally weighted risk gauge, but it's volatility adjusted. This one did fortunately finish in risk on. So I wanted to point that out. So this risk gauge over here likely is penalizing the leadership for the volatility, which prevented it from going into risk on. But when you measure the leadership volatility adjusted, it was strong enough and stable enough to actually register risk on. So again, this is at the margin. Things are solid and potentially getting better. But here's what I really want to point out, and that is, once again, cap weighted, which has been the leading version of the risk gauge for several years now. Cap weighted volatility adjusted. The medium term gauge is in the bottom half of mixed, and the short term gauge is hovering just above. So this is a clear difference in what's been happening over the past several months, where we're seeing equally weighted risk gauges, making their way up into the risk on area, whereas the cap weighted versions are struggling, particularly when you actually um, take the cap weighted version, you vol adjust it. Those low volatility mega cap names are falling out of the risk gauge. So again, that's to me part and parcel of this, it's just more evidence of this rotation into a very risk on, meaning speculative type of leadership. So this is the more not defensive, but more stable quality leadership, and it's that the risk gauge of that type of leadership is beginning to deteriorate while this continues to improve. Absolutely not bearish. It's just indicative of where we are in the cycle. So although the environment is closer to okay than awesome, what we can say and have been able to say for quite some time now is that the leadership is unmistakably bullish. So what we're looking at here is the month to date performance of the 28 motor groups sorted by their average gain for the month. And keep in mind, these are very big numbers, very good numbers, but this is after including Friday's bloodbath that many of these groups experienced. But nonetheless, looking at what happened last month, again, despite Friday's decline, clean energy, semis, precious metals, industrial metals, energy, capital goods, IT, and transports, with chemicals trying to work their way into leadership as well. This is all risk on either new era leadership, growth leadership, or late cycle. So it's all bullish, and there's nothing here to present any type of a warning about market transitioning towards safety. Now, having said that, when you do go down for the next four groups, it is indeed telecom, staples, banks, and utilities, which are certainly more defensive areas of the market. So again, as I've said, this is bullish leadership, but it's getting two things. It's getting more late cycle, and it's under attack from the defensive groups. So this is not bearish yet, and I will certainly show you that. But these are the things we're going to be watching as the year progresses. When you drill down, so these are the 28 groups. When you drill down to the leading industries, these are the top 30 industries, which are all subcomponents of the groups, and see what they did. I mean, these are just like shoot the lights out returns for the month. Data storage, which got hit pretty hard on Friday, was still up 43% for the month, with 83% advancing. So when you look at this leadership, it's bullish. And at this stage of the game, I don't see anything to not like here, despite Friday's decline. Um, these are the 30 worst performing groups on the month. There's a lot to point to here that I think is definitely worth watching as we go forward in the rest of the remainder of the year. Consumer credit, consumer loans, credit cards, and credit mortgages are all experienced in an otherwise up tape for the month, with very strong leadership posting very strong gains. These consumer credit sensitive industries were at the bottom of the rung with losses. So that's worth paying attention to. Um, so IT software is just absolutely getting obliterated. It can't get out of its own way. These are the returns for the worst industries within the group this month. 7% were up, so almost every stock was down. So that's clearly a negative for that group, and it's partly why tech as a group has worked as a sector has worked its way down the leadership. Um, and so let's see, I think we had one more thing I wanted to point out here. No, I think that was it. But overall, just as a summary, leadership is very good, although there's lots of problems with what's happening in the laggard part of the market. There's just too much good to worry about the sort of the regime that we're in at this point. Still constructive. Okay, so let's take a quick look at these new era industries. We highlighted these for our research clients back in June and July, and have been developing them a bit more as as time has gone on. What I mean by developing them a bit more, we just made some more changes. Remember, we had a group called Drones, Space, and Robots. We broke that up, and so now we have robotics and autonomy as its own industry, air mobility and drones, and space systems and communications. And so after having breaking them up, they are still the three of them are still among the leadership, which you can see over here. These are all of the hype or new era industries that we highlighted, and then they're just sorted by best to worst. And we also just this weekend we also broke. We had a lot of the data center companies that began as crypto companies mapped to the crypto industry. So this weekend, we also removed those companies from here and created a new industry here, which is data center high performance computing. And when you break them out of this group, they shot up to the top. Like when I say to the top, I mean literally the top. So the at the end of the day, though, these are the hype or new era leadership groups, and you can see that after having identified them, we have all of them except for three of them that are in the top half of leadership. With outside of this 45, the rest of them are 25 and better. So we can say that, which means that the long-term structure of these groups is still quite strong. We can see there's a lot of pressure more recently in these groups, especially even the data center group with a 76 very short-term momentum, also taking it on the chin a bit. But as we always say, we have this here to recognize and acknowledge the short-term weakness, but we want to compare it to the long-term score to see if there's any damage being done. And thus far, the only group that we can identify as really having a problem is this crypto space, which has been one of our favorites for quite a while. But of course, with crypto, Bitcoin itself, which I'll talk about in a moment, quite weak in breaking down again, actually, this weekend. At one point, I think it was down 10% earlier today. But I have an important chart updating that. But with that weakness, this group is not just very weak, it's actually the weakest group, weakest industry of the 181 industries we follow. That it's also been so weak that it's done damage to the long-term momentum score as well. So this is a group speaking specifically to the crypto industry, which we would now distinguish from the data center and high performance computing. This is a group that we would avoid at this point. But then, with the weakness that it's experienced, with all this red over here, and particularly on Friday, what we want to see is a couple things. One is what has that done to structure in near-term momentum? So we over here we see the percentage of each group that is above the 15-day average, and we can see a number of these are very oversold. So um, very oversold is okay as long as overall structure is still constructive, which I think it is. So I do believe that this is setting up as a an oversold condition that we can eventually reallocate to. One reason I would say that is because again, this column here shows the percentage of stocks in the industry with a rising 200-day average, and this is all very, very constructive. And so that essentially what you're looking at here is a very oversold condition into what is otherwise an environment with broadly speaking, rising 200-day averages. And then when you actually look at this from a trend model perspective, once again, um, the most of these groups, actually, if you look over here, most of the groups have a majority of stocks in a medium term, which is trends measured over months. So these can be months or quarters. These are long-term trends. Most of them are constructive, which compares to 62% for the broad market. So not only are they constructive, but most of these are better than the market average. And some of them still retain the clear up trend label as being the biggest bucket. So clear up trend is trending without any consolidation. To the extent that there are consolidations, they're oversold bases in an uptrend. So that's an uptrend that's in a base and oversold. So this would be the worst case scenario amongst the leadership. So uh, at this point, although we've had a great month with this leadership, as I just showed you, it's been very strong. Friday was a pretty nasty correction, but as far as I can tell, there's nothing to panic about at this stage of the game, particularly given that leadership overall, broadly speaking, even outside of these new era industries, leadership remains constructive as well. So I want to update this chart again only because I do think that it's one of the most important charts in the market today, because it does speak volumes about the environment that we're in, that we actually are in, despite what the S&P and perhaps NASDAQ are saying. But this, as I've been highlighting unfortunately, over the years, this is the value line geometric average, which is what the average stock is doing, sort of like an equally weighted index. This average peaked in late 2021. So the risk gauge turned bullish in through here, into this window, and stayed bullish in through just about here. And this was the last time the risk gauge was bullish. And you look here and you can now see why it's been struggling to really endorse what the S&P is trying to label as a bull market. So this is a chart that many of you may not be familiar with. So another way to look at this data is to say, well, if we look at all of the stocks that are in the motor universe, which is about 3,000 stocks, and we focus in on this period here, which is at least according to this chart, is the peak of the last bull market. And we just say, let's look at where every stock is in relation to this high. And that's what this table down here is doing. So what we can see is that since this decline, 64% of the motor universe has broken through this high at some point. So since this low, 64% have gone above this high. But what this table, this column is showing you is that although 64%, which by the way is not a large number, that means 36% still have not yet gone above this high. That's how bad it's been. But although 64, roughly two-thirds have gone above this high, currently only 41% are above that high. So again, this is an environment where most stocks are still engaged in a bear market, despite what the S&P is saying. So this is why the risk gauge is struggling. This is very much an environment that you would expect to see beneath the surface in what is otherwise a bubble environment. The last time that the value line geometric average was this divergent with the S&P 500 was 1998 to 2000, mid to late 2000, mid to late 2000, when the last bubble formed and ultimately peaked. And so this is, again, as I've been saying, this is not bearish. In fact, although I'm saying it's a bubble, as I've been saying over and over again, you want to embrace the bubble, run with the leadership as long as it's still intact, which I just showed you it is. But just as a reminder, this is what's going on beneath the surface. So let's not lose sight of that, because this is a very important relationship to acknowledge and monitor. So taking a quick look at the late cycle and defensive nature of the leadership. These are the 28 groups again. So this time we're just sorting them by their current momentum score. And when you look here, once again, you can see predominantly growth in cyclical leadership. But once again, we are starting to see more and more late cycle energy is right here. In materials and chemicals, both late cycle. This materials is like construction materials. So mid to late cycle, both of them trying to get up off the mat here. They still have middling long-term scores, but their short-term scores are very strong. And we've been combing through this on a regular basis. You'll see a number of the ideas that are in the swing trade portal are going to come from here. We've already featured a number of energy names, and transports as well, shippers. So these are all later cycle leadership. And so again, it's not bearish. It's just indicative and descriptive of where we are. But what I wanted to do now is just say, okay, well, if energy is coming on strong and if materials are coming on strong, can we put that into context to get a sense for where we are in that cycle? And so this is energy relative to the S&P 500. And you can see that this is the turn that our trend models and relative performance and everything else is picking up on here. You can see the turn here, but you can also see that it hasn't even broken its downtrend yet, which means that if it's going to do this, it's early. This is an early turn, and is we could be looking at more something like this for a bit before it finally accelerates higher. That's energy, and then materials, which I just showed you, is also working its way up the ranks, is also very early, if indeed if it's going to take on leadership. Within materials, what we know, and we've been talking about this for a number of months, the industrial metals has been very strong, and this is breaking out of a multi-year, nearly a 10-year base relative to the S&P 500. So this is likely a very important turn. Perhaps we get something like this, but it's something we want to stay focused on and remain long. And then on the defensive side, one of the best charts to monitor is simply low volatility stocks versus high beta, and this is basically falling out of bed. So there's no indication here whatsoever that this is going to take on leadership. Now, admittedly, it plunged right here, but it still took a number of months before it finally started to turn higher in preparation for what was to follow in the 2022 bear market. And of course, low vol outperformed uh, high beta leading up to and of course during COVID as well. So low vol will outperform high beta in the next downturn, and this is where it stands right now. So that also looks like it's a ways away if it's going to happen this year. And then part of that low vol basket, of course, is staples, nowhere near turning at this point, and you can see staples are down here, threatening with a 10 in the very short term, but so far that has made very little, if no progress at all in turning that long-term momentum score, and you can see that here. And then lastly, the other, I think, important group to monitor from a defensive perspective is the REITs, which also down here you can see is an 18, so kind of middling in the very short term and quite weak in the long term. And you can see that manifesting in a relative performance downtrend that's nowhere near turning yet. So from a a late cycle leadership perspective, if indeed this is getting set to happen, which I do think, these charts would tell us that we're a ways away from it being like fully exploited. We're kind of early in that turn, and then eventually what would typically follow that is defensive stocks and groups leading, and we're again nowhere near that being the case yet either. So I think we know where we are, and I think it seems to me like we have time before we have to worry about a bearish cycle at this point. And one other thing I'm watching, and I think a lot of folks are really excited about the credit spreads and how they're really low. And I mean, I guess at least it's descriptive of a non-risk on and risk off environment, which is good, obviously. But what we can see here is that the credit spreads are actually getting below where they were leading into the global financial crisis when they spiked during essentially credit Armageddon. And what has puzzled me is how everybody's so excited about how how narrow credit spreads are. And again, I understand what it means in terms of confidence in the markets, but being so excited about credit spreads being as low as they were in the leading into the global financial crisis is very similar to being super excited about the idea that the S&P is trading at over 30 times trend earnings, because this is a valuation metric. This is telling you how expensive corporate credit is relative to treasuries, and it's as expensive as it was back to just before the global financial crisis. So I'm not as excited as everybody else on this idea of where we are credit spread wise. The good news is they're not turning up. They're not threatening to turn higher yet. But I want to also keep in front of you this chart, which is a subcomponent of the index I just showed you. And this is triple C rated option adjusted spread. And as I showed you, remember the value line geometric average, and I showed you that it peaked in late 2021. Well, that's when the credit spreads on triple C bottomed and began to turn up with that bear market that ensued. And since then, although credit spreads, broadly speaking, are now below this level, you can see that the triple C rated spreads are nowhere near even their 2021 lows. So this is a clear and obvious divergence within credit. Not too many people are talking about this, but this is something I think that it could be a potential early warning on things getting worse going forward if this indeed turns higher, while broadly speaking, credit spreads seem to be fine. And this is the Bitcoin chart that I told you I'd feature. And so these zones here, this is the monthly, sorry, this is the quarterly projected momentum zone. So these, again, these zones are projected at the start of the quarter. So this zone was projected here. This one was projected actually right when the quarter started. So and I should say it was tested right when the quarter started, but this zone was projected here, and you can see they last for the entire quarter. And so we have this is the big slide that we had at the beginning of 2025, went right into the projected momentum zone for the quarter and held, and crypto Bitcoin went off to new highs. And this is the latter part of 2025, and the momentum zone was broken, so that doesn't put it into a downtrend, but at least in that long-term quarterly time frame. But what it does do is it takes away all of the momentum from that trend, which at the best case scenario results in this. Worst case scenario results in a full test of the quarterly support zone. And that's what we've been targeting. It turns out we actually got that today with a roughly 10% decline. So what we've been talking about is in the notes is that we have this notion or this acronym that we like to use to kind of describe this kind of setup. And we call it a high NABI, which is hold your nose and buy it. And these are just small allocations. They're speculative allocations. We almost like it's like a scout position just to kind of put it out there and see what happens. But if we get into the low 70s on crypto, that'll be into the overlapping quarterly, oops, sorry, the overlapping quarterly support zone, as well as the projected yearly momentum zone. So this is a major level. This level hasn't been touched by crypto in a very long time. But we have overlapping support between the yearly momentum zone and the quarterly support zone. So if we get into the low 70s, that's where I plan to make a small high NABI allocation, and then see what happens from there. But if it's going to hold, and this is all just people freaking out about crypto, this is where it's going to hold. And so we'll just make a small allocation, see what happens. If we get stopped out, we do. But if not, we'll just continue to build a position, much like this opportunity presented. And when it starts to break out again, we can just make it a bigger bet. But that's where it stands as of now. And we also get this question a lot. Is gold and silver in a bubble? And I think if you look at this chart of silver back to the 70s, I think the answer is a pretty obvious yes. This is accelerating today at a vertical rate of ascent. Silver prior to Friday's 20, I think it was 26% decline, was up almost 50% in a month. So that's very much a blow off top. And what happened on Friday with the metal was down, as you can see here, was down 27% at the close. That decline, that 1 day decline, is the largest 1 day decline in silver's history back to the 1970s. So when you go back and when you line up similar significant declines, 1 day declines from silver on the chart, you see that not always, but many of them, most of them line up with significant declines in silver. So even this one here, where we had a big decline, and it actually was followed by a decent rally after that, it was just as quickly followed by another big decline that resulted in a pretty decent bout of weakness into the 2022 period. So here we are today. As I showed you the structure of the precious metals group just recently on a couple of slides ago, and it looks fine to me. 100% of precious metals are still in a medium-term time frame uptrend, and very, very oversold. So if this is the end, keeping in mind that I do think that all of this comes to an end at some point in 2026. But if this is like that warning shot across the bow that says that we're taking steps towards the end of this cycle, then I just don't think that what happened on Friday was the end. I think it's a step in that direction, and we very likely see new highs, at least from the metals companies, and we'll see if there's a divergence between that and the metal itself. But in terms of all of this working its way through and becoming a top. I think we're very early in it, assuming that that is indeed where we are to begin with. And then lastly, I'll just finish with a dollar. This is, I think, a super important chart. As I've been writing in the notes, we are longer term structurally, secularly bearish the dollar, but there's so much support beneath the dollar at this point that uh, the the idea of getting bearish into weakness is risky. And so this is a weekly chart, and this is the yearly support zone for projected support zone for the dollar. To me, if you get into this zone, as bearish as I am on the dollar, this is exactly where you do not want to get bearish the dollar. In fact, this might even be a very good spot to place a speculative long or cover your shorts if you're already short. Um, the idea is that I covered this. I think it was in Monday's weekly motor report, but we broke this clear top, went right into the yearly support zone and took off. And then we tried to come down through and to it again, to and through it again, took off again. So I just think there's that risk. And we can point to this chart and say, well, yeah, but this time's different because we broke the uptrend. Unfortunately, we did that here too. So, I think the idea is not that it's not bearish. We are bearish the dollar, but it just as we go between now and the point where you really want to press bearish bets, I think there's just risks that you get a pretty explosive rally. Friday was a good example. We had actually the dollar was up pretty solid on Friday after testing its what you can see here is the quarterly support zone. So. Um, just a quick update on the dollar. Ultimately bearish, very likely feeds into into our longer term bearish view on equities, which will, we believe, culminate after the bubble is over. That all kind of feeds on itself. We can start to see that the Mag 7 is beginning to weaken, both relative to the S&P, but also in that the risk gauge that I showed you, the volatility adjusted cap weighted risk gauge is starting to deteriorate. There's a lot of foreign capital tied up in those mega cap companies. So as they start to turn down and the dollar starts to turn down and the bubble culminates in its terminal phase, all of that kind of feeds into the bigger picture bearish view that we have. But between now and then, as January demonstrated, you can make an awful lot of money participating on the long side as long as structure is still healthy. And that's where we think we are. Structure is still healthy. So um, the environment's speculative, but you want to just participate as long as it's healthy and just keep an eye on the exits and maintain your proper risk profile throughout. So just to summarize, Friday's hit to the new era leadership probably does matter, but it just doesn't matter yet, at least in our view at this point. We're very mindful that the leadership is very speculative, increasingly late cycle, with defensive groups threatening to take over. But nonetheless, the market regime remains okay and arguably getting better, at least for small to mid caps. And the leadership structure remains quite positive. So this oversold condition that we're experiencing is taking place into still positive structure. So although we probably have a bit more volatility to experience before things stabilize, that all is taking place in what is still at the margin a constructive environment. So right here in that regard, thinking about things that are really oversold, we are watching Bitcoin very closely for a potential small high NABI hold your nose and buy it allocation. But for now, we're still on the sidelines. And then just to conclude with this point, we do think the bubble thesis remains intact with the terminal phase likely sometime in late 2026, potentially focused on the midterm elections, which will be in November. A lot of volatility and perhaps a lot of excitement leading up to it, and then that with the bubble culminating in that period of time. But that's a loose roadmap. As always, we're focused on the data as it is, and we'll respond to that as it unfolds. But that's just kind of how we're seeing things and what we think the market is telling us. So thanks so much for watching and tuning in this month, as always. And if you have any questions, feel free to reach out to me at any time. You can see my email address here. And again, thanks for tuning in, and we will talk to you next month. Thanks so much.